Good morning, everyone. Here we are again, the Three Consulting Amigos. And today we're going to get a little help from Ed Lasak on better understanding ESOPs. They can be very helpful, but there are also some constraints that make it not a viable option for many employees. So Ron or Ed, if you would, please take it away here and help us better understand ESOPs and how and why we might want to use them.
Yeah, let me jump in real fast, Ed, if you don't mind, and just say that our last ESOP program was far and away our largest number of attendees. It beat the next program like 3 or 4 times. So there must be a huge interest in employee stock ownership plans, and so we thought it would be appropriate to dig in a little deeper, and that's what Ed is doing today. So this will be a kind of a natural junction with the last one. Yeah.
Okay, well, I think I will start by kind of giving a quick summary of the exit options that everyone has available to them when they're thinking about selling their business. Real quickly here, the family transfer is probably the one that's the most frequently happens, and it's probably very much more difficult to do than we realize. We've had many shows on that, but it seems to be the way a lot of entrepreneurs think about transferring the ownership of their business on their family. And then there's some talk and some opportunity of selling to the management team, and the management team has the expertise of running the business, but seldom have the money or the desire of owning the business. So that's that option. And then the third option of an internal sale is existing partners, a partner buyout. And in that situation, it's hard to find a special partner, and it's hard to find partners that aren't already associated with the business. They just don't know about the business and don't know about the opportunity. The fourth internal option to me has a lot of potential. We're going to talk about that today in detail. And that's selling to your employees as part of an ESOP. And just to finish this slide up, there are 4 ways of selling the business outside of the company, and that is sale to a third party. Most likely you try to sell to a strategic buyer who will offer you the best price. Not always the best net price, but the best price because of the synergies involved. Recapitalization, opportunity to invest and restructure the business. A lot of times there's a private equity role in this type of sale. And initial public offering, IPO, a lot of people dream about it, but pretty much it's a pipe dream. It's very hard to do and doesn't apply to most small businesses. And then unfortunately, the last one may be the most popular, is people just give up on their business and they liquidate it. And we have a good friend in Illinois right now. He's got a business and he's making quite a bit of money, but he has nobody wants to buy it. And he has nobody internally to offer the business to. So now I'm going to get into, so why not sell to employees? I think it's becoming a very popular option. And in doing so, you need to know a little bit about an ESOP, which I think most people really don't truly understand what an ESOP is. So the objective of this program is to give you a little bit more knowledge so that you better understand it and get more information on it, because I think it's a very viable option. It is a tax efficient leverage buyout, and the company borrows money to purchase shares, borrows the money from existing shareholders and from the bank, and that's what starts the process moving forward. Employees don't own shares in the company directly. They own accounts that have shares allocated to them in a trust. It's like an IRA. It's not a real true sale. It's to a trust, and it's a ERISA trust that is supposed to be for an employee benefit. It's governed by the Department of Labor as part of ERISA and IRS regulations. And the DOL has always had a burr about ESOPs, and They're all over them, and they're trying to become more compatible with them in the future. But so far, we have like 6,257 ESOP companies in the United States right now. So a lot of people are taking advantage of this. One of the biggest benefits is the tax qualifications. It's like an IRA. There's no tax until the funds are distributed. There's significant tax advantages, which is probably the major issue, because it might not be the highest price. It'll be a price at fair market value. But by the time you look at all the tax incentives, it probably nets the greatest amount to the owner, the seller of the company. And we're going to get into that a little bit. I'll have some examples in that area. This here is supposed to be a simplified diagram of how an ESOP works. And you're not going to become an expert on this. I mean, just look at all the arrows and how it moves around. But basically, let me see if I can just summarize it real quickly so you get an idea how it works. The company secures loans from banks and the owners. The bank, that's step number one. Step number two, the company issues inside loan to the trust. And the trust purchases shares from the owners. And then number four, the company contributes funds to the ESOPs from earnings. Every year they make money, they pay a portion as a contribution to the ESOP. The ESOP trust makes a loan payment to the company, and then the company repays a loan to the outside vendor, outside bank, or to one of the shareholders after the loan has been paid to the bank. And ESOP trust issues account balances to employees. So you don't get stock, you get an account like your IRA, and that tells you how much money you have in the ESOP trust. ESOPs pay employees when they leave or retirement. That's a big deal with the DOL. You have to do that. So you have to build that into your cash flow estimates as you move forward.
Is there typically, Ed, I'm sure there's a retention period, right? I mean, you know, the employee can't go out immediately. Do you have to stay a certain amount of time typically, or?
Well, no, the point is, that's a very good point. Initially, when you do the transaction, it's fully leveraged. The only way you build value is you build value from that point in time.
Okay.
So after the ESOP's created, from that point in time, the company does better and better and better. Hopefully, as it does, that incremental value goes to the employees.
Okay.
So you're kind of splitting it up. You're splitting the company up. As of now, it all goes to the shareholder, whatever that value is, but earnings beyond that point goes to the trust, which benefits all the employees of the company. So what's a perfect ESOP company? Well, the owner wants a few years to transition out of the business. That's really important because a lot of times the owners, as we have talked about in many programs, the owners are the business. So they have to be there to make sure there's a proper moving forward, proper turnover here to move forward, handoff. That's what I'm looking for.
Right, right.
And you have to have a capable management team in place. The company has to be growing, and you really can't have a lot of debt on your balance sheet because you're going to be leveraging all your assets to make this sale happen.
Let me ask you a question, if I can,
Sure.
maybe for clarification. When you say an owner wants a few years to transition out, so you know, basically what you're saying is that this is an opportunity for the owner who may not have prepared the business for his departure to spend a couple of years in which he can develop a team that can run it after his absence. Is that accurate?
No, I think the owner has I think you have to have a company where the owner has a capable management team in place, but the owner sticks around for a few years to make sure everything keeps moving forward until all the loans are paid off.
Okay.
The owner just can't exit right away because he's got too much skin in the game to exit and have something go bad.
Right.
And
so it has to be a big enough company to have a full management team that can be paid and productive within the company.
that's a very good point, Ron. That's absolute essential component of a company that would be perfect for an ESOP company. That's correct. And obviously the last one's important too, because if they're full of debt, it's really hard to get any more debt to make the transaction work. So they have to be low debt on their balance sheet. So the balance sheet's really important.
And you would certainly hope that after 20, 30, 40 years in business, that it would be a low debt company. Yeah.
Right.
Right. It's compelling advantages to the owner. Just think of this, and Ron will appreciate this one. You can sell your company confidentially. No one's going to know about it at fair market value. And this is really important if you don't have a market for the company. And there are some companies that don't have a market.
Yeah, a lot of them actually.
Yeah, so this is a way of selling your business that you don't have to have a market. And all you have to have is a valuation. And once that valuation is made, you can sell the company. And there's other legal things you have to deal with it as well. But that's really the main concept for the ESOP company.
And your last one, it protects the employees. I mean, there are a lot of companies with 50, 100 employees who have spent many years at a company. And so protecting them, giving them a place to finish out their retirement years and develop a little bit of retirement equity is a pretty nice thing for employees.
I think most owners love their employees and want to take care of their employees.
Yeah.
And if they sell it to a third party and lose all ownership and all control, that does not protect the employees a lot of times. A lot of times employees can be eliminated and moved into another operation. So yeah, this is a perfect option for that.
Yeah.
You don't have to do 100% ESOP. You can do a 30% ESOP.
Yeah, I think
taking some chips off the table, which is pretty important.
Right. I recall clients that I knew who did it in two pieces, 50% the first time and then 50% later, and it worked out, ideally for him and as a point of reference, was really good for the employees as well.
Yeah. So then it comes down to the biggest advantage is the taxes. And I'm going to show you a slide next that kind of puts that into perspective. But basically here, you're going to get probably the best price, net price, not the greatest sales price. You're only going to be able to sell it for fair market value. But you're going to probably net the best amount of money because of the tax incentives associated with an ESOP. Yeah. Okay. This is the compelling tax effect of this. This is pretty interesting. This is probably a program all by itself, but basically California tax right now for the high income earners is 13.3%. And we've been reading off and on by various groups that the plan is to move it to 18%. And remember when we were younger, when we were planning for our future, we always tried to defer our taxes until we retired because the tax rates would be lower.
Yeah.
This slide pretty much says the opposite.
Yeah.
Capital gains is a real big one. Look at this one. Right now it's 20%. There's a lot of talk right now with the Biden proposal. It's going to go up to ordinary income of 39.6%. There won't be any capital gains tax anymore. It's all going to be ordinary income.
Wow.
So look at that. That's almost double. And, the Obamacare, the 3.8% didn't used to exist. That's all because of the healthcare initiatives. Mm-hmm. That's a new tax and that'll stay forever. But when I add them up, and it's theoretically you can't add them up because you get a deduction for California tax on your federal return. But look at the impact of taxes. So to me, with this kind of information, you would kind of think that if you have the ability to do an ESOP for your company, it kind of makes sense.
Mm.
Yeah. Are you going to do another slide now, Ed, on the tax benefits?
Well, we're going to talk about the benefits to employees.
Okay.
Yeah, the employees enjoy working for an employee-owned company. they feel like owners, they get rewarded for superior financial performance. And that's a big deal. They don't do that. They don't get that now with their current ownership.
Right.
More transparency, more improved corporate governance. You pay more for this, but it requires a company to act like a company and not like a family business. Less perceived need for union representation, and retirement benefits are significantly better.
Wow.
Disadvantages: owner can't walk away initially. His expertise are needed till the loans are paid off. The company must continue growing. If your company has a problem with growth, it's not going to last very long. It's not going to make it. You're going to be cash strapped until loans are paid off, which means, a lot of initiatives you're trying to improve the performance of the company requires investments. You're going to be pretty much maxed out on the liability side, on the debt side. So you're not going to have the access to debts until funding until the debts are paid off. Cash flow commitments for buying out departing employees. When they leave, they have to get their money for their account balances. And complicated increased regulations from the DOL and the IRS. To me, it's a price of running a more professional business, but it does cost approximately about $70,000 a year in fees. You need a valuation. You need an audit or a financial review, which some companies don't have. And also, there's an increased burden on the controller. There's more of a need for a CFO in a business of this nature. And then, obviously, the purchase price can't exceed fair market value. It can't be a price better than that. So that pretty much concludes it. I know I want to make sure we have plenty of time for questions on this.
Yeah, I have one. Kind of driven by that last slide. What would happen to the owner if the company went broke in 3 or 4 years? Does he lose something? Does he lose his notes? How does that work?
Well, yeah, he'll lose his note. He won't get paid off.
Okay, so
yeah.
it has to continue operating at least until the note is paid off. Yes. Which might be, what, 10 years or something like that?
I think they estimate 3 to 5 years.
Oh, 3 to 5.
Yeah.
So now once that owner is paid, and then if the company goes broke, then the owner would be sort of out free and clear?
Yes.
Yeah, okay.
He's got his money and he can move on.
Yeah. Now, what kind of tax advantages then would he receive? Say he sells his company for well, we keep it round numbers, for $1 million. That's probably a little low, but say $1 million. And he gets that back over 5 years, $200,000 a year. What kind of advantages would he have in his taxes through that period?
Okay, well, let's talk about that. It's a great question. So let's say his basis in the property was $500,000, and he had $500,000 of profit when he sold the company. Mm-hmm. Right now, he would have to pay capital gains at 23.6%, something of that nature.
Yeah.
And if he does it next year, and if the Biden proposal comes into effect, he'll have to pay almost 50% mm-hmm. of taxes on that. But if he meets the requirements of the 1042, he won't have to pay any capital gains tax. It could be deferred forever. So that's an advantage.
Oh, really? So it really takes that capital gains away from him.
Yeah, it can. You have to invest in certain types of investments.
That's a tremendous
It's a tremendous advantage. Absolutely. Yeah. The other thing is when you're paying off your loans, you're making your contributions to the plan, and you're paying off your loans, you get to deduct on your tax return not only the interest of those payments, but also the principal. So think about
the company does.
The company does, yes.
Yeah, right. And so the company can keep its profits low for a while anyway, while it's being paid off. Just, I suppose, just as if it had borrowed money from someplace else and you can deduct the interest. That's the same principle, right?
And that's right. And then the third point is once there's requirements, but you can switch from a C Corp to an S Corp. And when you switch to an S Corp, that means that all the money that is made by the company is no longer taxed.
But it flows through to 100 owners.
It flows through to what? Excuse me?
It flows, that tax liability would flow through to all of the owners, right? Like it's set with normal subchapter S.
Yeah, it would be a subchapter S. So anything that the company makes goes to this tax deferred or tax exempt organization. And that means that the owners of that don't have to pay any tax.
Oh, you mean the organization is tax exempt itself?
Yes.
And therefore there are no taxes, no subchapter S taxes.
No.
Period.
The only time it's taxed is when employees leave and they get their distribution, just like an IRA,
right,
or 401k. When they get their distribution, they will have to pay income tax on that portion that they receive.
So income tax or capital gains tax?
Income tax.
They have to pay income tax.
Just like it's very, very similar to the 401k or the.
So somebody makes $50,000 a year, and then for 10 years they have this accumulation of $10,000 a year. Say it would be sort of tax-free growth. At the end of that time, they would have another $50,000 in value that they would get paid off. But now they have to take their last year's income of 50 plus the 50,000. They're now getting taxed at a $100,000 rate.
Yes, it's when they get their payment, they would have to pay. They would have to pay.
So hopefully they would quit and get their payment the next day.
Yeah,
in the next year or something like that. But but I can. In other words, my point is that just like taking stock gains, in that particular year, you've got a tax liability that could double or triple.
Yeah.
And therefore throw you into a higher tax bracket. And that happened to me. Last year.
I have to research this, but I'm pretty sure you can roll it into an IRA. The employees can.
Oh, okay. So
I'm not positive of that, but it sure seems to make sense.
So
get all in one year.
If you could do that, that would be great. And then you would only pay whatever your distributions are. Okay. Yeah.
Think of the advantage though to a company that has a subchapter S, that's an ESOP, and it accumulates all this cash because they don't have to pay tax.
I think that's just an incredible thing. And actually, when you take a look at the potential taxes that have been proposed by Biden, the ones that we've already had, and the potential new taxes, especially in California, it makes you wonder how you can make any money at all. and so you almost have to start looking for ways to avoid the tax just in order to make it worthwhile. And this is one of the saddest parts about being in business, is that the risks are so tremendous, and the hard work is long and ceaseless. And the current taxing environment is so abusive that it really makes it hard to make any money. And just in a regular successful business, 10 employees, 15 employees, you've worked hard in order to find a market. You're there every day working, your fingers to the bone. And then when you finally start making some money, you make a nice income of, $100,000 income, not get rich, but you do okay. You're paying those taxes. And then on everything else you make in the business, you're paying extraordinary taxes. It makes you wonder why you should be in business.
Yeah, well, that's true.
Well,
but think about this: when you don't have to, when the corporation doesn't have tax, they accumulate a lot of cash. That means they have the ability to buy other companies, and a lot of companies are purchased by ESOP companies because of that situation.
Oh, wow. So in other words,
Advantage.
An ESOP can grow by purchase of other companies. They don't have to necessarily grow organically. Is that correct?
That's right. They would do both probably because they'll have the cash at hand to make those investments because they don't have to pay income tax.
Can you help us, or maybe a listener a little bit, Ed? What would be a good candidate for an ESOP? Dollar volume, etc., number of employees, so that somebody could look at this and say, hey, this might be an option for me.
Well, they have to be probably somewhere around the $15 million range, $10 to $15 million in revenue.
Okay.
About probably $1.5 million to $2 million in EBITDA to have an opportunity to take this on. But the biggest thing is the owner has to stay around, and you have to have a capable management team in place to make this thing work. And your company has to be growing.
What's the annual cost to do this? I mean, is this something that's cheap, or is it expensive? Tell us a little bit about that.
Yeah, I estimate anywhere in my slide I put 70,000. I'm thinking somewhere between $50,000 and $70,000. And the two biggest components there is you have to have legal representation. You have to have a valuation performed every year by your company, for your company, and you have to have either a reviewed financial statement or an audited financial statement. And to a lot of companies, they don't have those things.
Right.
So those are new costs of operating.
Yeah.
On the other side of the coin, though, when you think about it, it requires the company to operate like a company with lots of transparency, making sure everybody's doing things the right way, rather than maybe some of the more gray areas that family companies take to operate because they don't have to share that information with anybody else.
Right.
Yeah. A lot of them are so private, they don't, and I think we would probably all agree that most private companies are better off if they would pay attention to all of the elements that would satisfy these requirements. And we've talked about it many times, but an outside advisory board and several of those kinds of elements in order to be able to be held accountable really to somebody other than yourself. Ironically, most small business people go into business because they don't want anybody to tell them what to do. And the problem is that they don't do well because nobody's holding their feet to the fire, and they don't have the discipline to do it themselves. So it's kind of an interesting dichotomy there.
Yeah, it really truly is. I have worked for some companies like that, right, Ray? When we talked about the ESOP, there's just no way they want anybody looking over their shoulder.
Right.
Yeah, no, it's I mean, that's one of the prices of independence. It's like you can be independent, but then if you don't have the courage or the ability to be able to take advice from outsiders, then that becomes a challenge. That's why I think, a lot of the clients who are members of either Convene, which is a Christian organization, or Vistage, they get a lot of input from other people to help them make better decisions. And I think that's really important in today's environment. Being able to have outside input as to what you're doing and be open to it. And I think, as Ron pointed out, some people are not.
Oh, so it's not for everybody, that's for sure.
Yeah.
But one thing that is very important to business owners, they don't want to pay tax because they work hard for their money and they don't want to see it all going to the government. So this is an option. It might not be the perfect option for them, but it's one for them at least to consider. And I think the other issue is a lot of times business owners don't want to bring in advisors. They want to do everything on themselves, by themselves. And I think in this situation, you have to have advisors that can help you get through this process.
Yeah, I think that's pretty clear because you've got to have that group of people, the professionals. Because really, I mean, in a sense, the trust really is to keep the operational integrity so that the employees have something.
Right.
You know, when you give them the stock, it's you know, they have to know that it's going to be managed appropriately. Now that's another, I think, major question, and that is how involved are the employees in running the business once they have an account or they think that they own stock in the company?
Well, that's another great question. And this isn't pre-taped, folks. This is all live. This is good. Yeah, it's they don't have any more control over the company than they did before.
Okay.
The only thing they have is the benefit of an annual evaluation. Numbers are audited, and it's protected by a trustee who's employed to protect them as part of this trust.
Yeah.
So
Well,
the protection increases.
And I
say so, not so much.
What I think it does do, and certainly I think you could attest to that, Ed, you know, basically as the employees are able to see the data and really understand the numbers, you know, they begin to appreciate how their contribution can either help the company grow or not grow. And there tends to be a lot of internal pressure on people who are not performing at a high level. You know, the 2 years history, the sewer monkeys have no place to hide because basically they're now affecting the other employees who are looking at this and trying to make decisions. Is that fair?
Oh man, that's another great point that you're making. That's absolutely correct. You feel like you're part of something. There are no hidden secrets. Your contribution, it's been documented in studies that people perform more effectively in this type of environment because they feel like there's a return for them. Whereas in a regular privately held company, that's not always the case.
Right.
So there's all kinds of studies that they'll do things against their personal nature for the benefit of the company because they know they're going to share in the results. So that's a big plus. And why would you want union representation of a company that you theoretically own through a trust?
Right.
So, you know, I think there's a lot of advantages, and I think it puts everything blue collar and white collar on the same page.
Yes. And, you know, that's been my mantra for years is that what you want is a no collar workforce.
Yeah.
Everybody's working together because it's in their best interest, as opposed to, you know, well, I'm not doing it because I'm a blue collar and nobody cares.
Yes. Yeah.
Well, I'm wondering about this competitive nature between employees. You know, first of all, the shares that an individual employee get, they're tied, I believe we talked about before, they're tied to how much income they have, right? So
the shares are, yeah, that's right. They're tied on based upon their compensation.
So now you've got people saying, I've never been properly paid here, and Joe does the same job I do. Now, maybe he's been here a little longer or whatever, but he's sort of like the owner's pet. And he always got bigger raises than I did, and et cetera, et cetera. And so, you know, one guy's making $50,000 and the other's making $65,000. And the $50,000 guy is now resenting the other guy because he's gotten raises for all of these years, and he never felt like he was doing the same job. So you can see the tension that you could potentially have there. And I'm wondering, in your experience, I mean, have you run into these kinds of employee problems where they can't really be dealt with?
Well, that's another excellent point you're making. And I can only compare it to a privately held company. When you have a privately held company where there's no transparency and the owner can do whatever he wants, I think there's more of a chance for employees to be treated unfairly because of past relationships or personal relationships that the owner may have. When you move the company into an ESOP environment, you're moving it into a more professional organization. The owner is no longer leading the charge. It has a CEO that is making the decisions for the company. So it's kind of interesting. It's no longer the owner making the decisions. That's a big distinction. It's the new CEO, and that person is evaluated annually by the board. So they're not
So I
doing a good job, they get fired.
I'm just
Yeah,
thinking
yeah.
thinking of these companies that have been poorly run. They may be profitable and maybe everybody's sort of happy, but poorly run in the sense that they haven't had good employee evaluations, and they don't have a good, strong system that is followed on a regular basis to do those evaluations, and that the evaluations are also instrumental in the raises that they receive, and that the raises that are put out there are serious efforts to properly distribute them based on performance in the company that would make a difference to the bottom line. I mean, if you don't have these kinds of things, you have lots of inequities. And once the inequities are shown, I can see where you could go through a period of time where you're really going to have to deal with a bunch of stuff that is legacy stuff that the owner never really dealt with, because the owner was always a wimp and never really stood up to good, strong policy, never had the dedication to consistency so that everybody could feel like they were really properly treated. So, I mean, if the company's not well run, this looks like this opens up all kinds of problems to me.
Or you can look at it as being opportunities for
Yeah.
running a more professionally oriented company that's doing things the right way based upon professional management rather than ownership that could be biased.
Well, but I thought we talked about the fact that you've got to have your management team. Well, that's already in place.
Yeah.
If the management team who's been in place for 4 or 5 years hasn't done this, what assurances does the employee have that the management team is going to change? And I would say very little.
Well,
I was gonna make a reference to a client that I knew that actually had, migrated from one CEO to another CEO. Sorry about this. And it was done internally, but it was done for the best interest of the company. And as a consequence, it still continued to grow. The first CEO was disillusioned. He felt he wasn't getting the contribution he needed to. And so it was reference to your point, Ron, that sometimes people are not happy about how they're being compensated or whatever.
Yeah.
But, they were able to make the transition, and the new guy came in and continued moving forward without a hitch.
Well, I think that's always, you're always going to have those kinds of things. And there, a lot of times it's a perception of an employee that doesn't really exist either.
Yeah.
It's the employee's problem. It's not really the organization's problem. And of course, the management team needs to understand and learn and know how to deal with that. But getting good employees in the right places that have the right attitude, the right motivation, of course, is a serious issue today. And just getting somebody to show up is an issue, let alone ones that are not backbiting and all the other things that go on. But I just wanted to throw that out, because I think that you have to go into something like this with your eyes wide open. That you're going to unleash unexpected things that you might not have planned on.
That's very true.
Well, and I think it's true, but I think to the point that Ed made in the first place is that of all the companies that I've seen, this particular model is the most transparent.
Right.
Everybody gets to see what's going on, and as a consequence, because it should be professionally managed, those things that occur, like you're referring to, Ron, can be addressed and actually dealt with, because everybody knows what's going on, and there is a financial benefit to being able to fix the problem, and the employees know that. When they recognize, it's, and I've seen this, and you've seen it too. One of the things that I've observed watching a CEO keep a bad employee is that everybody in the organization saying, when are you going to do your job?
Right. You're right.
You know, and so when that transition happens, everybody says, well, great, it's about time.
Yeah.
I think the ESOP does an effective job of managing that, or giving you an opportunity to make the right decisions. And sometimes, as we know, you know, even this guy that I'm talking about, who had the ESOP and did very well at it, you know, he was told several times by people he had to get a new CFO, but well, he's a friend of mine and blah, blah, blah. You know, I mean, we still have relationships that sometimes get in the way of what's best for the company.
Right.
And, you know, in retrospect, he said, I wish I'd made the decision 2 years earlier, but I didn't.
Yeah.
Well, I had that in my personal career. I went into a privately held company, 2 of them actually, and they had all kinds of opportunities, but the ownership wasn't capable or open to making those changes. And when I came on board, we moved forward and made all those changes and realized all those benefits because they couldn't do it themselves, but they would allow us the opportunity to do so. And I think the same situation goes here. I think you have a better chance with an ESOP on making improvements than you do with some family-run businesses that they're just so used to doing things a certain way, and they're so adverse to making the hard decisions.
Right. Right.
Because they know the people, they've been to their weddings, and
Yeah,
they've been to the funerals, they
yeah,
know the families. It's really difficult.
Yeah, you bet.
Well, I think this has been very helpful. I'm glad that you took the time to do it again, Ed, because I think this probably answers questions that are obviously, as Ron said, of interest to a lot of people. So I'm hoping that this will be well received, and thank you again for taking the time to put it together.
Thank you very much, gentlemen. Great questions. Well done.
Great.
You bet. We'll see you next time.
Yes.
Thank you.